It's a group of people where they operate the business, whether it's a commercial business or industrial business. Any company registered in India as per the Companies Act, that company is called Indian company. The foreign company will be treated as non-resident of India. We are going to call the company in different names, that is partnership firm, proprietorship or a corporation. Hello everyone, I am Arun Kumar, lecturer in Department of Commerce and Management, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. Dear students, welcome to this new session on unit number 4, that is assessment of companies. So moving forward, here we are going to learn about company. So what is this company? So a company is a legal entity formed by group of individuals to engage and operate a business. Yes, so company is a group of individuals which is engaged in and operate a business, commercial or industrial enterprise. Yes, it's a group of people where they operate the business, whether it's a commercial business or industrial business. A company may be organized in a various ways for tax and financial liability purposes, depending on the corporate law of its jurisdictions. The line of business the company is in will generally determine which business structure it chooses, such as a partnership, proprietorship, corporation. These structures also denote the ownership structure of the company. So the company or the business line, the line of business of the company will be generally known by in what way they run the business, whether it's a partnership firm or whether it's an individual, that is, proprietorship, or it is a corporation, that is a company. In partnership firm, there will be more than two parties. They require minimum more than two parties to call it as partnership firm. If there are more than 15, 20, 30 or 100 members, then it will be called as company. Then to call it as proprietorship, if only one person is running the company or the business entity, then that business is called proprietorship. So we are going to call the company in different names, that is partnership firm, proprietorship or a corporation. The structure also denotes the ownership structure of the company. Yes, by knowing that whether it's a proprietorship or partnership or corporation, we'll get to know the kind of ownership the company has. So they can also be distinguished between private and public companies. Both have different ownership, structures, regulations and financial reporting requirements. Yes, they can also be distinguished between private and public companies. So easily we'll get to know whether it's a public company or private company, because the rules and regulations are different for public company as well as for private company. So if it is a private company, the rules and regulations are different. They are supposed to follow different norms. If they are public company, yes, again the rules and regulations are different and they are supposed to follow the new norms or the different kind of norms compared to the private company. Next, in companies we have different types of companies. So with respect to this subject or this particular chapter, we have 4 types of companies. In that, the first company is Indian company. The first type of company is Indian company. So what is this Indian company? A company registered in India is an Indian company. Yes, if any company is registered in India as per the Companies Act, any company registered in India as per the Companies Act, that company is called Indian company. If that company is in India and if it is registered under the Companies Act, then it is a Indian company. An Indian company is the one registered in India under the Companies Act of 1956. Yes, as I said, the Indian company is the company which is registered under the Companies Act 1956. So Indian company is treated as resident in India. Yes, so we are supposed to determine the residential status of the company in order to impose the tax. If it is Indian company, the rate of tax will be different. If it is foreign company, the rate of tax will be different. In case if the proprietor is in India, if the business is run by individual person, if the proprietor is in India, for him the tax treatment is different. Okay, fine, we have a company but the proprietor is not in India, is abroad, then for him the tax treatment will be different. So here, if the company is in India and the company is treated as the resident in India, so it has to pay tax in India for its global income. Yes, it is supposed to pay, the company is supposed to pay the tax in India for its global income. The company will be earning the income from different sources, from different countries. Okay, from different branches, from different countries. But the company is supposed to pay the tax in India on the global income. That is called Indian companies. Once again, I'll explain you. A company registered in India is an Indian company. An Indian company is the one registered in India under the Companies Act 1956, and Indian company is treated as resident in India and it has to pay tax in India for its global income. So this is called Indian company. So what is the second kind of company we have? The second kind of company is foreign company. So what is this foreign company? A foreign company is defined as an entity which is incorporated outside India. Yes, which is incorporated outside India, but as a place of business in India or conducts any business activity in India in any other manner. Yes, foreign company is nothing but it is a company or the entity which is incorporated outside India. It is not registered in India. Okay, a company is not registered in India. It is registered outside India. But they will be doing some business in India. They will be doing some business in India. Those kind of companies are called foreign companies. They are not registered in India. They are registered in some other country. But they also having their business in our country, in India. Those kind of business entities are called foreign companies. And it is treated as non-resident in India. It has to pay tax on Indian income. Yes, the foreign company will be treated as non-resident of India. The foreign company is treated as non-resident of India and they are supposed to pay the tax on Indian income. Whatever the tax they collect, okay, whatever the tax they collect or whatever the income they earn, the foreign companies, whatever the income they earn in India, on that income they are supposed to pay tax to the government. But Indian company, they are supposed to pay tax on the global income. If they are earning globally, they are supposed to pay tax on global income. But foreign company, they are registered in different country, but they are operating in India also. Okay, they are operating in India also and they are called non-resident companies. They are called non-resident companies and they are supposed to pay tax on the Indian income. So whatever the income they earn in India, on that income they are supposed to pay tax. So this is called foreign company. Next one, widely held company. So what is this widely held company? So a company in which public are substantially interested are called widely held company. The public interested are called widely held company. The shares of the company are widely distributed over millions of shareholders and are traded daily over the stock exchanges. Yes, very easily we can say that these widely held companies are public held company or government companies, government undertaking companies. So in public held companies, the people will be investing their money, the individuals or the public will be investing the money to that particular company in the form of shares. So the shares, the people are going to invest through shares and that shares will be traded in the stock exchange on daily basis. So this is called widely held company. So once again I'll tell you, a company in which public are substantially interested are called widely held company. So in this widely held company, the public people will be having the interest, they will be showing the interest and they will be investing their money in that company. The public will be investing their money in that company and those company shares will be traded in the stock market on daily basis. Next one, closely held company. So a company in which the public are not substantially interested is known as closely held company. Yes, in closely held company, the public will not be having much interest. Those companies are called closely held company. And the majority of the shares are held by a small group of shareholders, and these shares are publicly traded on occasions but not on a regular basis. Yes, in widely held company, the shares will be traded on daily basis, but in closely held companies, only few people will be having the shares, and those people are called shareholders. The shares will be traded occasionally, not on a regular basis. That is called closely held company. So totally we discussed about 4 types of companies. One is Indian company, the second one is foreign company, third one is widely held company, fourth one closely held company. So moving further, residential status of company. Yes, based on the residential status of the company, we will be imposing the tax on the income of the company. So knowing the residential status of a company is very much important in order to impose the rate of tax on any company. So residential status of company under the Income Tax Act 1961. Yes, there are some rules are determined under the Income Tax Act of 1961. We are supposed to follow those rules in order to find out the residential status of a company. So what the Income Tax Act 1961 says? So it says Section 6 subsection 3 of the Income Tax Act 1961 provides that a company is said to be resident in India in any previous year. Yes, if any company is said to be a resident in India in any previous year, if the company is an Indian resident. Yes, if the company is an Indian resident, or if the company is registered in India, it will be called as resident in India. Or its place of effective management in that year is in India. Yes, if it is incorporated in India, or if it is called Indian resident, then it is an Indian resident company, or the effective management, the place of effective management is in India, then those companies are also called Indian companies, and those companies are called resident in India. Resident in India. The first thing, the company is an Indian resident. If the company is an Indian resident, then it is an Indian resident company. Or if the place of effective management is in India, then Dutch companies are also called the resident companies of India. So this is how we are going to determine the residential status of a company under the Income Tax Act of 1961 under Section 6 subsection 3. So moving further, to know the format to compute the business income, that is the company's income. So we have to make 3 columns: particulars, amount. So net profit as per P&L account. Net profit as per P&L account, that is profit and loss account. So that will be given in your P&L account. What will be the net profit? That you are supposed to take it in the outer column. Next, for net profit, you are supposed to add disallowed items. So what is this disallowed items? Disallowed items are those items which are not supposed to be taken in the debit side of the P&L account. That means as expenditures. They are not supposed to be shown as expenditures in P&L account. But what assessee did? Assessee is going to show some other expenditures as business expenditures. Actually, those expenditures are not business expenditures. But what assessee will do, in order to reduce the profit, he is going to show some other expenditures as business expenditures in debit side of the profit and loss account. So what we are supposed to do, if it is not relating to business, if that expenditure is not relating to business, just you have to add back it to the net profit. So see here, which are the items which not comes under the profit and loss account, which items which not comes under the expenditure side. The items are any reserves. Okay, so any reserves, if any reserve is made, reserve for bad debts, reserve for dividends, if any reserve is made, then that reserve is not considered as business expenditure. So you are supposed to add back it to the net profit, inner column amount. Next, any provisions. If any provisions is made, any provisions are also not business expenditure. If it is shown in the P&L account in expenditure side, just add back it to the net profit. Any provisions. Next, any advance payments. Yes, in case any advance payment is made, advance payment is also not a business expenditure. Just add back it to the net profit. Next, income tax paid. Income tax paid, it is a responsibility of the assessee. It is not an expenditure. It is the obligation and the responsibility of the assessee to pay income tax to the government. So we will not be considering it as business expenditure. So just add back the income tax to net profit. Next, excess depreciation. Yes, he is supposed to claim 10,000 rupees. But how much he claimed? He claimed 12,000 rupees. He is supposed to claim 10, but he claimed 12. What is the excess amount? Claimed 2,000. So just add back that 2,000 depreciation, that is excess depreciation. Next, donations paid. All donations comes under deductions. Now you can't claim it as expenditure, it's a deduction. Next, payment in cash. Any cash payment is made, that will not be considered as business expenditure, that should be add back to the net profit. Next, purchase of assets. On purchase of assets, you can claim depreciation, but you can't show it as business expenditure. So these items, you can see these items in expenditure side of the P&L account. If you find these items in the expenditure side of the P&L account, just add back this item to the net profit. That's it. So total it, you'll get some total. Total it with the net profit. You'll get some total here. Next, from this total, less allowable expenses and other than business income. See, in the credit side, you will be giving you some incomes, business incomes and other incomes. Only we are supposed to take the business income. If other income is given, that should be deducted. The other income is given, that should be deducted. And allowable expenses is nothing but he is supposed to claim some expenditure as business expenditure in debit side, but he forgot to claim. But that will be given in the adjustment. Those kind of expenditures can claim under this deduction. So what and all items comes? Interest on government securities. See, interest on government securities, this item comes under income from other sources, not under business, right? So that should be add back. Next, dividend received. It comes under income from other sources, but it's shown it in business income. So just deduct it. Next, rent received. Yes, rent received is also comes under house property, not under business. Then deduct this. Next, capital gain. If any capital gain income is given, that comes under capital gain, not under business. So deduct it. So take it to outer column, the total you will get. So from this total, you deduct this total, the balance you will get. This balance is called business income. The balance is called business income. Very easy to understand, and you'll get this question for 15 marks in your exam. Compulsorily you get this question for 15 marks in your exam. Just you have to write down the net profit, and from net profit, for net profit, add disallowed items. The items which are not considered as business expenditures, just add back those items, then total it, then deduct the items which are not considered as business incomes, and just deduct the allowable expenses which are not claimed under profit and loss account. Then you will get some balance. That balance is called business income. Next, moving further, format for computation of income. So here you are going to find out the total income of the business. What is the total income of the business? There you will be finding out only the income which is respect to the company. But here the total income of the business or the company. So income from salary always it will be nil, because company is not going to earn any salary. Next, income from house property. Yes, if company is owning any house and if it is let out by the company, then if any income is earned, then it comes under income from house property. Next, income from business and profession. Yes, we will be finding out the income from profession here. Just you are supposed to copy the amount here. Next, income from capital gain. So what you are supposed to do, if any capital gain is earned by the company, then you are supposed to show it here under income from capital gain head. Next, income from other sources. Yes, if any income is earned under income from other sources, like here you can see dividend received comes under income from other sources, and interest on government securities comes under other sources. So those incomes are supposed to be shown under income from other sources. So total the 5 heads of income, you will get some total. This total is called gross total income. So from gross total income, less deduction under section 80C to 80U. So there are some deductions under section 80C to 80U. Give deductions, you will get some balance. This balance is called total income of company. The balance is called total income of company. Next, the last format is computation of tax payable. Computation of tax payable. So particular amount. So tax on total income. So what will be the total income? You are going to write it in inner column. So in that, the first tax on long-term capital gain. If you have long-term capital gain in total income, first you tax long-term capital gain. Next you tax short-term capital gain at 15%. Okay, first you are going to tax long-term capital gain if it is there in the total income at 20%. Next 15% on short-term capital gain. You will get the balance amount. You will get the tax on other income is nothing but the balance amount after taxing long-term and short-term. In this total, you are going to tax short-term and long-term. Some balance you will get. On that balance, you are supposed to impose 30% of tax. You are supposed to impose 30% of tax. Then you add these three. Then you will get some total. On this total, compute 4% of education cess. Secondary and higher education cess at the rate of 4%. So compute 4% on this value. You will get some value. You just add that value. You will get some total. The total is called tax payable by the company. So this is how we are supposed to calculate the business income of the company, total income of the company, and tax payable by the company. So in today's class, dear students, we discussed about what is company and what are the types of company we have, and also we discussed about how to compute the company's business income and the total income of the company, and also how to compute the tax payable by the company. So with this, I'll wind up the session. In the upcoming classes, we solve few problems based on assessment of company. Until then, thank you all.